But I tell you what, these are, I'm not saying these are seismic changes, but after a really brutal corrective move in the Indian markets, it's important to take stock of what people who look at slightly longer term charts per se as well, on the institutional side, are thinking about. And Anu Jain, President Equity Advisory, NDPMS 361 Wealth, joins us right now on the show. Anu, great having you. Thanks for taking the time out and speaking with us. Couple of days ahead, Anu, but happy Women's Day to you and hope it's a wonderful one.
Thank you so much. And it's a pleasure to join.
Thank you. So, I mean, not just charts. I know you look at multiple things. I would love to know, how have you thought about the corrective move thus far and the uptick that we've seen in the last couple of days? Is the trend changing, or is this maybe a dead cat bounce?
The fact remains that you've fallen on the Nifty about, right from the 26,000 plus to about 22,000. And the last 1,000 points was pretty brutal. I mean, it didn't give you even one pullback. So what you're seeing right now is a relief rally. Now, the relief rally can actually establish a trading range for the next month, month and a half, till your next quarter results come in, which would be closer to 15th of April. Now, the fact that what we were really looking at and we were having our eyes on was on liquidity, given the fact that advanced tax and liquidity sucking happens around the 15th of March. With government and RBI having made that thing that there is money going to be there in the system, want to see how people handle the 31st March, handle results which start coming from 15th of, the early April to mid-May. So I think what you're in for is a 1.5 month of a very crucial period, which is difficult to predict. But if I were to put a finger that what is the high probability, I think there will be a trading range established between, say, 22,000 to 23,200. Market should move in the 1,000, 1,200 point range, given that it's once formed a bottom and bounced from there. For it to break 22,000 now, it would need either bad results or something globally again going, haywire. So yes, it is a difficult 4 to 6 weeks, but I think now we've seen one base, so I would call this a pullback rally.
Anu, hi, this is Harsh joining in. Want your take with regard to some names which have outperformed as part of the last 4 to 5 months of pain that we've seen. And a few of them straight up from the Nifty 50 space. You have a Bajaj Finance, you have Kotak, you have HDFC. What next for some of these? Because, of course, Bajaj has moved, but Kotak and HDFC just haven't. So I want your sense on where do some of these go?
So caveat, some of these are in our client portfolios and in our personal portfolios also. I think banking and financials as such has underperformed. With the first interest cut and the liquidity, I think NBFCs will definitely benefit from it. And that goes across board. It doesn't go just to Bajaj, but to the entire pack. And I think that will be a positive for them. On the banking side, whether it is HDFC, whether it is Kotak, they are coming out of a lean period, out of which Kotak is coming out from a much more leaner period than what HDFC is coming out. But I would still say that there are other banks which look technically at least sounder, even fundamentally giving better returns, better margins for the next 2 quarters. So I would probably say ICICI looks better. I am not trying to say you should sell HDFC if you're holding it. I think it will give you a good 16-17% CAGR for the next 3 years. But if I was looking for a winner out there in the large cap banking, I think it would be ICICI Bank.
Point taken, Anu. And you spoke about how come back to markets and to the larger market. You spoke about how you expect the Nifty to be in a range of 22 and 23,200. 22K and 23,200. What therefore would your strategy be? What are you advising clients at this point? Wait again for a bit of a correction, or do you go out and buy at this point?
See, the whole point right now is all this is decided basis your risk parameters. Their clients are ready to buy even now, and their clients are saying, no, this is not the end. So the strategy is always client specific and how comfortable they are to handle the market risk, because we know it's going to be a volatile market. For all you know, Harsh, this market will continue like this till the end of the year. There is a good 10-20% chance that the volatility which has started now will continue to September. So it is a period where comfort level, if a person can sleep through the night without getting worried about his portfolio, that's the strategy he or she should be taking. So we are ready to deploy fresh funds for clients, but we are triggering it or tranching it out depending on their risk profiles. If they are medium risk, we'll do it till September. If they are high risk, we'll do it in the next 2-3 months. And if they are really conservative, we'll probably do it till December. So we do have, our picks which have been identified. Each client portfolio is being looked at separately, and decisions are being made accordingly.
Anu, just wondering, for somebody who is not risk averse, and this market has plenty of those, so of course to each their own, and they might get crucified as well later on if the market were to pull back. But for somebody who is not risk averse, are small cap names coming into the picture at all? Because I mean, you don't need the index to be very cheap for finding reasonably priced stocks in such a large universe, right? So for the risk-taking investor client, are small caps featuring in the list, or are you only sticking to large caps?
So we're looking at stocks bottom up. We're not looking at whether they are a large cap or a mid cap. So we have decided on a basket of stocks that we like, and then depending, it's like we offer the buffet to the client. Then they choose what suits their risk ability.
I'm guessing you are not in a position to talk about some of the broader market names, or are you? You're not.
No.
Okay, fair call. Let me try and change the tact of the question, Anu. Some of the themes which have fallen quite a bit, are you liking any of those? And one of them which stands out for me at least was EMS, right? Because that's a sector that came out with high growth promise even after Q3. Valuations maybe still a bit stretched, but growth promise out there. So without getting into a specific name, but are the Dixons, Ambers of the world or the Keynes Techs of the world a preference list or no?
We've been holding some of these names, and we had taken, in some cases, 75% off, in some cases, 50% off, but we are holding the balance. We've not yet come to a point that we're comfortable adding to them now, but what we're holding, we're not giving up. I think given that they're still not really cheap, and this is, at least I cannot make a decision that, while I understand that the growths were good, and whether you look at most of the numbers for last quarter, there was a slowing of growth, or there was a postponement of, result was like, they said that it would kind of get 6 months delayed or 9 months delayed. So that would have to be seen in this quarter, how the quarter pans out, how much do they deliver versus what they have said. I think there is still some downside left, but we've seen whether, as you were taking the names, whether it's Dixon, whether it's Keynes, most of them have found first level of support. Now, depending on how this quarter results would be, it would then be wise to take a decision whether you want to add it even 5% higher or 10% higher, because the fact remains that if they've all fallen more than 30%. So even if you lose 10% of the rally and it's a 3-year stock, then it doesn't matter. But I think these are still at a point that if the market gives up again, or if they don't deliver this quarter, you can easily see another 10 to 15% fall from here also.
Right. Okay, Anu, one final question. The dollar index, for a lot of people, that will be a key determinant of what happens in the near term. Any thoughts there?
So if somebody had told me 2 months, 3 months ago, that you'll see the dollar index back at 104, I would have expected us to be at least 23,500, 24,000. The fact remains that whenever the dollar index comes out, money moves to the emerging markets. What you're seeing this time is money is moving out, but it's moving to, people are moving out from emerging market ETFs, indices, to just a pure China play. And in that process, we are still seeing outflows. So while I believe this is positive money going to emerging markets, I don't think for the next 1 or 2 months we're getting any share of it. So it will, again, as I said, we got that multiple or that premium because of our growth, which has slowed down in the last 2 quarters. We have to prove our worth by proving that we are growing faster. Else, we will not get the flows for at least a quarter or so.
Okay, point well noted. Anu, thank you so much for joining in and giving us those thoughts. Really appreciate your time this afternoon.
Thank you. Bye-bye.
That's Anu Jain with her thoughts. DXY notwithstanding, flows may be a factor of growth. It's something that Rhythm Desai mentioned, that it's a question of growth, and if growth comes back, things may just turn. I wonder, Harsh, what will happen if indeed the bullish estimates on Q4 growth turn out to be true?
Well, yes.